Hello and welcome to the weekly market metrics. I'm your host Sandeep Rao and we are in week 19 of 2026. That's almost 5 months into the year already. This week started with a massive political shakeup as the May 4th assembly election results saw the BJP making history in West Bengal. Actor Vijay's TVK party stunning everyone in Tamil Nadu and the UDF sweeping back to power in Kerala. Looking at the world at large, well, it's been a little over 2 months since the Iran conflict began, and there still doesn't seem to be any clear resolution in sight. Every now and then we get to hear about talks of a ceasefire, but as of yesterday, the situation still appears to be in limbo. If you go by this update from the Jerusalem Post, both sides continue to remain engaged in some sort of a conflict. And if that wasn't enough, the S&P 500 and Nasdaq Composite are both hovering close to their previous all-time highs, largely driven by a handful of major technology stocks, while our Nifty 50 still remains roughly 8% away from its highs. So for us, it's a bit of a double whammy. Not only are our markets struggling, but we are also not insulated from the second-order effects of the war, whether through commodities or currency. And on top of that, international ETFs listed in India continue to trade at fairly steep premiums, thanks to the overseas investment limits imposed by the Reserve Bank of India. But as always, not everything is bad. There are still pockets of strength within this market. Sectorally, there are areas that continue to hold up well, and those are some of the things we'll explore as we go through this week's update. So with that, let's get started with what happened last week, and then we would explore what could happen in the coming one. Let's get to our usual market metrics, starting with the rate of change across indexes. Very similar to last week, this week was also muted for Nifty, BANKNIFTY and SENSEX, which gained anywhere between 0.5 to 0.8%. The standout performer this week was MIDCPNIFTY, which gained 4.82% and made a new all-time high this week. The other three indexes are still 8 to 10% away from their previous all-time highs. If we look at it on a YTD basis, it's only MIDCPNIFTY which is in the positive territory. And not just the index, but the Nifty Midcap 100 index also made a new all-time high this week. Maybe investors are betting on mid-caps over large caps in the current scenario. It's also a reminder of the fact that when it comes to investing, you've got to be well diversified across market caps. But at the moment, if you know the reason why MIDCPNIFTY is trending compared to others, do let me know in the comments. Now let's look at Nifty across different time frames, starting with weekly. If you remember, last week Nifty made wicks on both sides of the weekly candle. This week as well, Nifty gained 0.74% or 179 points to close at 24,176, again leaving wicks on both sides of the candle. On a weekly time frame, Nifty is trading above its 10-week SMA but remains below its 20-week SMA and 40-week SMA, which are positioned at 24,600 and 25,000 respectively. These 10, 20 and 40-week SMAs are critical as they act as institutional benchmarks for short, medium and long-term trends. Prices staying below these levels typically means that the broader market bias remains under some pressure. The weekly range for Nifty was 600 points, which is slightly higher than last week's 538 points. But at the same time, it's worth noting that last week was only a 4-day trading week, while this week we had 5 full trading days. Talking about the range, Wednesday saw the highest daily range of 359 points, whereas Friday saw the lowest at 127 points. Such a narrow range on a Friday is quite strange, especially considering the number of highly volatile, wide Friday ranges that we have seen in the recent past. Moving on to the daily time frame, Nifty has been stuck in an approximately 1050 point range between 23,550 to 24,600 for a month now, and the price action remains quite choppy. A sustained move, whether it's on the upside or on the downside, will likely happen once the index breaks out of this 1000 point range. Currently, Nifty is trading above its 21-day EMA while it's below the 50 EMA, 100 EMA and the 200 SMA. This structure tells us that the index is stuck in a range with a clear downside bias. On the hourly time frame, Nifty is hovering around the 50 EMA, chopping through. Now, short-term trend followers are experiencing a death by 1,000 cuts in this kind of an environment. Neither longs nor shorts are working right now, and it reminds me of this meme.
अगर हम करें तो करें क्या, बोले तो बोले क्या?
Well, there are two ways in which short-term trend followers can survive this environment. One is by having a good laugh, and in all seriousness, two by keeping your position sizing in check. If you have observed over the past week, almost every day we saw a V-shaped market recovery. The market either opens up or down and continues in that direction for a while and then suddenly makes a sharp move in the opposite direction. What this tells us is there's some kind of an elevated level of intraday volatility going on, but surprisingly, neither the option premiums nor India VIX is reflecting that. It's a strange disconnect where the price action is wild, yet the fear gauge remains completely flat. Talking about Nifty's weekly expiry, which happened on Tuesday, 5th of May, the expiry had a range of just about 199 points, even lower than the previous week's expiry range of 221 points. At first glance, one might think this would have been an easy day for option writers. But the opening straddle premium was a mere 138 points. The index then proceeded to move down 200 points before recovering the same 200 points. So net, it was anything but an easy day for option writers. On the flip side, option buyers may have actually found some opportunities in those swings. If you are one of those option buyers, do let me know in the comments. Moving on to what to expect in the coming week. Well, as I had shared earlier, Nifty is stuck in a range between 23,550 to 24,600. Unless the index breaks out of this range, I would expect more consolidation or choppy price action all around. Now, what will help this index break out from this range? Maybe some definitive news on the Iran conflict, or other than that, I don't see any standard support or resistance levels working these days. If I look at the straddle premium to gauge the expected range until the coming weekly expiry, which is on Tuesday, May 12th, well, Nifty straddle price has closed at 283 points, which implies a move of roughly 1.17% on either side. But as we have seen over the past many weeks, this is largely the overnight risk premium that melts right at the open, and we hardly see any decay during the day. Let's see if this weekend is any different, but I don't really expect it to be. Talking about the range, well, the expected range as per the straddle chart is around 23,900 all the way to 24,450. My overall bias for Nifty is still sideways to bearish. Until the index breaks out of the 1,000-point range it is stuck in, I do not expect much to happen. We need some major catalyst to make that move happen. Let's see what it will be and how soon that happens. Moving on to the directional bias for all the four major indexes that we track, the primary update this week is that the short-term bias for SENSEX has shifted. For Nifty and SENSEX, the short-term bias is now positive while the medium-term bias remains negative. In case of BANKNIFTY, both the short-term and medium-term biases remain negative, reflecting the ongoing relative weakness in this index. Talking about MIDCPNIFTY, we've seen earlier it's been an outlier and its both short-term and medium-term biases remain positive. Just to be clear, a positive short-term bias in this context means SENSEX particularly has closed back above its 21-day EMA on a daily time frame, signaling a potential recovery in the immediate momentum. Moving on to India VIX, well, it's 9% this week to close at 16.84. While this fall is in line with the contracting daily ranges, it's still in absolute contrast to the intraday volatility which remains through the roof. Moving on to the sectoral performance this week, well, if you've been following us for the past few weeks, following the Tijori indexes, there are around 82 of them, and that makes it easy for us to identify niche sectors which have been standing out in any given market. This week's top 5 performers are wires and cables, microfinance, communication equipment, diagnostic chains, and packaged meat. There's almost no overlap from last week's indexes. However, if I look at the last week's top performers, transformers and upstream stood out, which were also close to the 52-week high, and this week both seem to have taken a pause. Now, overall, if we look at the 52-week high view, or more precisely, look at the sectors which are closest to their 52-week high or the ones which are making new highs, then last week we just had about 4 such sectors. There were transformers, defense, refractories, and upstream. But this week we've got 10 of them. At a very fundamental level, it talks about the increasing breadth of the market, which obviously is a good sign. And do notice the fact that while Nifty 50 is stuck in a range, there are some niche sectors which are making all-time highs. Now, overall, if I look at all the sectors, wires and cables seem to be a clear standout, up nearly 16% in just 7 days and 63% over the past year. I see a few things happening simultaneously for this sector in its advantage. On the power side, you have electrification happening at scale, both renewable and non-renewable, driving massive investments in transmission and distribution infrastructure. Then I hear that the railway is pushing for full network electrification, which again requires enormous quantities of cables across thousands of kilometers of the track. On top of that, we have 5G rollout going on, there are data centers and other urban infrastructure elements, all of these adding to the demand. So in a way, if I think about this sector, it's benefiting not just from one way, but multiple macro factors. Defense is another sector worth paying attention to. It's up close to 68% over the past year and is sitting right at its 52-week high again. If you see, the story here again is fairly simple and straightforward. The government has significantly stepped up its defense budget, and a growing share of that procurement is now being directed towards domestic manufacturers. So in a very simple sense, more money is flowing into these companies, and that's what is being reflected in the stock prices. And as I said last week, as far as these sectors are concerned, it's a good idea to look at these indexes and then double click on them to understand which stocks within these indexes are leading, and then accordingly take your pick. Moving on to commodities, if we look at it on a daily time frame, gold futures is hovering around 50 EMA and silver future is just above it, which is also reflecting in their weekly rate of change. Gold was up just about 0.9% and silver was up about 4%, and so was copper around 3%. Crude oil, on the other hand, is cooling off. It had a run up to close to $112, but with the ceasefire talks gaining some traction, we are seeing a minor pullback. Now, I wouldn't read too much into it. It's not like crude is going to head back to $60 or $70 range again anytime soon, but the immediate pressure seems to be easing a bit. Natural gas has been largely flat and no major moves there right now. So that's about it on commodities for the week. So all in all, in summary, the markets moved into a bit of a holding pattern this week. While Nifty, SENSEX and BANKNIFTY posted some gain, the real story was in the massive 5% surge in MIDCAPNIFTY, which made yet another all-time high. Nifty and SENSEX at the moment are showing some indecision as they hover around key moving averages, and BANKNIFTY continues to underperform. The weirdest part, as I told you earlier, is that while the VIX has crashed, the intraday price action is absolutely chaotic. Those sharp V-shaped recoveries meant that even though the daily range looked small, the choppy price action was enough to give trend followers and short vol traders sleepless nights. Sectoral strength is widening, which is a very good sign, with 10 sectors now near their 52-week highs. Wires and cables and defense are clear standouts to remember. And my bottom line on Nifty, we are stuck in a sideways grind with a slight bearish tilt. Until we get a definitive catalyst to break this 1000-point range, expect the indecision to continue, which also means choppiness in terms of price action. Well, moving on to what caught my attention this week, well, I've got two interesting recommendations for you this week. One for you to watch and one to read. Last week, the founder of CNN, Ted Turner, died at the age of 87. He was a pioneer of sorts in terms of cable news and specifically the 24-hour news which we take for granted today. If you are the watching type, then you could watch the Call Me Ted, a 2024 six-part documentary series which chronicles the life of this media mogul, covers his career, his interests in sailing and launching of the 24-hour news, a bit of his personal life and all of that. There's also a book title by the same name if you're one of those who would want to read. The second recommendation for the week is this Aeon article about Ethiopian runners. This article focuses on two different styles of training for a marathon. One is a very personalized, Western, data-oriented, individualized approach, and then the Ethiopian approach, which is more collective and human. While the article is about running a marathon per se, but it made me think about how we look at the markets as well. The link will be in the show notes. Now moving on to the events to factor in for the coming week. The April CPI inflation, which is the Consumer Price Index data, is set for a release on Tuesday, 12th of May, and the WPI inflation, which is the Wholesale Price Index, follows on Thursday, May 14th. You can actually track all these economic and other major events for yourself through the events calendar of Zerodha. The link will be in the show notes. With that, we wrap this week's weekly market metrics. If you find this series useful, please don't forget to subscribe and do feel free to share it with your friends and family. Until then, stay curious, stay steady, and enjoy your weekend.